AI stocks are absolutely exploding right now. But most beginners are buying them the wrong way. If you're feeling lost between the hype, the headlines, and the real long-term opportunities, then stay with me. In this video, I'm going to give you a simple, step-by-step framework to invest in AI the right way for 2026, even if you're starting from zero. Welcome to Future Finance Lab, where we break down AI and the future of finance in plain English. In the next few minutes, you'll learn a complete beginner's framework to build a safe foundation. Understand where the AI money is really made, pick smarter AI investments, and avoid the biggest beginner mistakes. If that sounds useful, hit that subscribe button so you don't miss our next AI investing deep dive. Alright, step 1. Build your foundation before you touch any AI stocks. Before you invest a single dollar into AI, you need a solid base. Make sure you have an emergency fund set up that is usually 3 to 6 months of your living expenses in cash or a high-yield savings account. AI is volatile. Your rent is not. Your core portfolio should be, frankly, a little boring and diversified. Think broad index funds or ETFs that own hundreds of companies, not just AI. Only after you have that foundation do you create an AI slice of your portfolio. This is typically 5 to 15% of your total investments, depending on your risk tolerance. Think of it like a pizza. Your diversified investments are the base, and AI is just one exciting slice, not the whole thing. Step 2. Learn the AI value chain. Most beginners only look at the flashy AI apps. Smart investors look at the entire supply chain. There are 4 major layers you need to understand. First, you have the chips and hardware companies making the GPUs and servers that power AI models. Next is the cloud and infrastructure layer, the big platforms renting out all that AI computing power. Then you have the AI applications themselves, the software using AI in products for productivity, healthcare, and finance. Finally, there are the picks and shovels, the hidden winners like data centers, energy companies, and cybersecurity firms that keep the whole AI ecosystem running. When you hear about an AI stock, ask yourself, which layer of this value chain is it in? That alone will make your research 10 times clearer. Step 3. Use the DISRUPT checklist. This is a simple framework I created to judge any AI investment. D is for disruption. Is this company actually changing an industry or just adding AI to their marketing? I is for innovation speed. Are they releasing new features fast or getting left behind? S is for scalability. If demand doubles, can their product scale without costs exploding? R is for resilience. Can they survive a recession or competition from big tech? U is for user adoption. Are real customers actually using and paying for it, or is it just hype? P is for profit path. Is there a believable way for them to make strong profits? And T is for time horizon. Is this a 1-year play or a 10-year story? Does that match your own timeline? When you buy one share, you're spreading your risk across dozens of companies instead of betting it all on one. You can build a simple structure like 85 to 95% in your diversified core portfolio, and then 5 to 15% in 1 or 2 AI-focused ETFs. This way, you still get to participate in the growth of AI, but one company's bad earnings report won't wreck your portfolio. Finally, step 5. Your risk management and 2026 game plan. Here's how to manage this smartly through 2026. Start small. Your first goal is to learn, not get rich overnight. Automate your contributions, add a fixed amount monthly instead of trying to time the market. Rebalance regularly. Once or twice a year, check if your AI slice has grown too big. If AI suddenly becomes 30% of your portfolio, you might want to trim it back to your target. And most importantly, avoid the hype. If you're buying a stock only because social media is screaming about it, just pause. Go back to your DISRUPT checklist. So, the right way to invest in AI is simple. Build a solid foundation, understand the value chain, use a clear checklist, and let ETFs do the heavy lifting.